Commercial banks will be under pressure to keep interest rates on loans low over the next 2 months, following the decision by the central bank to cut its policy rate from 9% to 8.5% during Monday's Monetary Policy Committee meeting. The meeting, which was the CBK's first since the repeal of rate caps, is intended to set the tone of pricing of loans in an environment in which banks are not restricted on how high they can set interest rates. All eyes were on the Central Bank's Monetary Policy Committee as it converged for the first time since Section 33B of the Banking Act was repealed, effectively doing away with the cap on lending rates. In the 3 years and 2 months that the cap on lending rates had been in place, the central bank was steadfastly vocal in its opposition to the rate cap, particularly on the extent to which it was harming the economy.
In the end, the data will show that it is quite damaging to the economy, it's quite damaging to our own people. The people that we expected to help are the ones that are hurt the most.
In this period, the central bank only adjusted the benchmark rate twice as an indication of the level of caution it was assuming, as it remained wary of the perverse effects of a lower benchmark rate in stifling credit access to the private sector a lot further. The CBK also suffered a blow when, in its March 2019 pronouncement, the High Court ruled that whereas the cap on lending rates was unconstitutional, it was not persuaded that it undermined monetary policy formulation. Monday's decision, coming against the backdrop of the repeal on the law capping interest rates, was also informed by a broadly stable shilling, which closed Monday's trade at 101.55 units to the US dollar, having gained from a low of 104.21 touched in July 2019. The decision has also come as inflation has been trending at lows favorable for accommodative monetary policy, having fallen to 3.8% in September 2019. Going forward, the banking regulator has the task of closely monitoring whether banks will adhere to a new normal of moderately high interest rate charges, even as it hopes that this traumatic scenario envisaged 2 years ago will be avoided.
When the interest rate caps are removed, banks continue to behave the same way they used to behave in the past. So we go back to where we were before. That would be traumatic.
The real test now lies in seeing whether growth of credit to the private sector will accelerate following the repeal of caps and slashing the benchmark rate by 50 basis points today. The market is eagerly waiting to see how commercial banks will price their loans going forward and whether or not they have learned their lesson of desisting from exploiting their customers.